Steve Peterson here with Infinity Investments, and welcome to our channel where we talk all things commercial and investment real estate. In today's video, we're going to be talking about the third point on our 1031 success checklist, which is a checklist we developed to help investors navigate through 1031 exchanges efficiently and successfully. In other words, when we define success in a 1031 by acquiring a better asset while deferring the capital gains taxes. So we've developed a 9-point 1031 success checklist. Click the link below, download it. And I've done a series of videos, 2 videos on the first 2 points. The third point in our 1031 success checklist is to evaluate your existing property's return on equity. Evaluate your existing property's return on equity. All right. Point number 1 is have an investment plan. Point number 2 is to define your investment criteria. So when you sell your property, what are you going to buy? And number 3 is to really understand what is your property making you, right? When you first acquired a property, you looked at your return on investment, how much money you put into the property, right? In relationship to how much money you're yielding every year, how much cash flow you're making on that investment, right? Well, we're assuming that you've owned the property for a while, and now that investment of cash has turned to a nice chunk of equity. Should be more than what your investment of cash is, but maybe not. Now what we need to do is see how your equity is performing. You have an idea of how your cash is performing, but how is your equity, right? And if you bought 5 years ago, 2, 3, 4, 5 years ago, you got significant amount of equity in your property, depending on where you are in the country and the world. But here in California, if you bought any time before 2019, you got a significant amount of equity, right? And so now we got to figure out what is that equity doing for us? Because if we're considering an exchange, remember we said exchange success is buying a better asset. We need to make sure that we find an asset that is going to deliver more cash flow to you, right? And what does that mean? All right, when we look at the property's equity, we got to look at the value of the property minus any mortgages or liens against the property minus the cost of sale, right? The cost of sale is when you list the property, you're going to have to pay brokerage commission fees and transfer tax typically and other closing costs. That's going to be anywhere from 5 to 6%, 6 to 7% of the sale price. So you take the value, your sale price, minus your loans and liens, minus your cost of sale. That is the property's net equity. That's the money you have to play with if you sold your property and you do an exchange. And the reason we need to evaluate that first, what are you earning on the property now? What are you earning on the property's equity now? So that we can decipher if we go and we exchange your property, can we buy something that's going to make you more money than you're earning now on the property's equity, right? So it's a simple calculation where we take the net equity, that once we figured it out, I just gave you the formula how to figure that out in relationship to the property's cash flow. The formula for return, that measure is called return on equity. Now, if you guys invest in the stock market or you're in accounting, you will heard this term return on equity a lot in the stock market. You're going to hear this in business. That's an accounting term, return on equity, right? In real estate, it is very similar, but a little bit slightly different, all right? The formula for ROE, return on equity, is the property's net cash flow, so net cash flow divided by the property's net equity. So net cash flow divided by net equity, right? And that's going to equal your return on equity. And many times, if the property's equity went up, the value of the property went up, your return on equity is going to be a lot lower than your initial return on investment. All right, you're making a good amount of money on that money you invested, but that money, cash you invested, now turned into a lot more equity, right? And you're probably not making as much money on your equity as you are on your cash, right? And if that's the case, it could be time to exchange. Now, it also could be time to refinance, take some cash out, go buy something else. You can do that as well. But if you are thinking about exchanging, right? And that's why I'm doing this video for people who are thinking about exchanging, for brokers and agents who are working with clients who either are going to be exchanging or thinking about exchanging. It's good for us to do this analysis up front so that we can then look at the marketplace and see, can we go make this person some more money? Or if you're the investor, can I then sell this and exchange it and go make some more money? So you need to know what your equity is yielding you, right? And if you look and say, hey, well, look, my equity is only making me 1 or 2%, right? Especially if you're in a market where you get a lot of appreciation. As the property value goes up, as equity increases, the ROE diminishes, or return on equity goes down because you have a bigger number of equity. And typically, especially in a place like California, your equity growth is going to outpace your cash flow growth. And that's most places in the country. So if you're looking at, hey, can I take this money out in the marketplace and go make more than my return on equity, right? If you can, if you look at the market and you see, hey, well, these are market prices and this is what I can do, you might be a good candidate for a 1031 exchange, because now you can take that equity that you have, sell it, and go and invest into another property to make you more cash flow. The whole bottom line is more cash flow. Can you buy a better asset? There's other things to consider when you're buying a property in terms of better asset, the physical condition of the property, the location of the property, all those things considered. The bottom line though, if you're gonna do this, you need to make more money, right? And we don't want to exchange you and get you into a property you didn't pay taxes, but now you're making less money. That's not the purpose of this. And I want to reiterate that a lot, because I see that too many times. People get a great offer on a property. Maybe they weren't even thinking about selling. Now they got all this cash. And they go buy something. They overpay for something just because they don't want to pay taxes, right? Versus having a plotted out, planned out, methodical approach to how we're going to go about doing our exchange. And so I hope this helps just in terms. I mean, it's a basic fundamental thing. I know a lot of you guys with a lot of experience in this is odd. It seems basic. But a lot of very sophisticated investors miss this. And sometimes when you know a lot, it's easy to forget the fundamentals, right? You get all these sophisticated techniques, it's easy to miss the fundamentals. What I'm telling you guys is let's not miss those fundamentals. In fact, let's master those fundamentals. And what you'll find in many cases, especially if you've had a big value growth appreciation, your return on equity is probably less than 2 or 3%. All right, if it's less than 2 or 3%, I would almost say most assuredly you can go out there and exchange and do a lot better. All right, so I hope this helps. I hope this clarifies, some of the helps you to clarify the decision of are you going to sell, are you going to exchange, and does it make sense? And if it does, like this, share it with friends, subscribe to our stations. We got a bunch of content like this coming out weekly, and let's stay tapped in, because we want to make you. We want to give you as much information that you can to be successful in your real estate investing career. To the next video, hope you be well, and peace.